This video is going to explain the basics of how a taxpayer like you and I, and companies and trusts can claim a deduction for an expense. What's deductible and what's not, and what are the rules for working that out? Because nobody likes paying tax. Duh. So, one of the ways that taxpayers, that is you, can reduce your tax bill is by claiming allowable deductions against your income. But naturally, you can't just claim a deduction for any old expense. So, that brand new LED curved TV that you just purchased is sadly out of scope. For an expense to be deductible, it must meet certain criteria. So let's jump in and have a look at the different types of allowable deductions. There are generally two broad categories of deductions. On one hand, you have your general deductions. These are deductions that are covered under Section 8-1 of the Income Tax Assessment Act 1997, or what we call the 97 Act. On the other hand, you have specific deductions for certain types of expenses, and these are covered by Section 8-5, and a whole list is available at Section 12-5 of the 97 Act. Let's take a look at each category of these deductions in more detail. So, general deductions first. For something to be a deduction, it must meet one of two criteria. Wait, back up a second. First of all, for something to be deductible, it needs to be a loss or an outgoing, first of all, right? Because you can't claim reduction for something that you have actually gained, right? So you need to have actually spent some money or, incurred a loss or an expense. Let's just be clear about that first. Okay, back to where we were. So it must meet one of two criterias, which are called, the positive limbs. It should either be incurred in gaining or producing a taxpayer's assessable income, or necessarily incurred in carrying on a business for the purpose of gaining or producing assessable income. Like I said, these are known as positive limbs, and a taxpayer must pass at least one of the above for the expense to be deductible.